traders, another busy day for us, so let's just jump right into it, taking a look at the alerts that I sent out today. Now, there's very much a focus that I have right now on the longer term time frames as we rally up higher into resistance levels that I've been waiting for on daily time frames. Now, attention, as I've learned a long time ago, and I was taught in actually motorcycle road racing school, is like a dollar. You have $1 worth of attention. It's 100 pennies. And if, 60 of those pennies, 60 cents of that dollar is being spent on identifying retracements and levels and looking for momentum and the, puts that I want to buy in a lot of these cases, confirmation, etc., then that means I've only got about 40 cents to be day trading or doing other things with. And so at some point you're going to find when you're sort of torn between two different worlds, day trading in this case for me versus the retracements on the daily time frames, I'm going to let the day trades go because I'll have another set of day trades tomorrow and another set of day trades conceivably the day after that, etc. But I may not get the opportunity in the zones on the daily time frame again at that level with this momentum. So I think that in these situations, I'll prioritize the daily, and that's exactly what you see in front of you. These are a copy and paste of the alerts that went out. So by the way, every day I send out the notes, and if you take a look at today's notes, you'll notice we have everything from XLK QQQ explainer to the countries that I want to short again on rallies like Hong Kong, Singapore, South Korea, Australia, China itself. We've even added, in addition, we've even added EEM. I'm looking at puts in the EEM, so we'll add that to our overall approach with some of these stocks. In fact, the EEM trade is going to be waiting for the EEM chart to trade up into 35.80 to 36, and at that point I'll then look at the bid for the 36 puts for June, and if and when I do that, I'll send an alert out. But let's put that on the radar. Talked about why we want to stick with long dollar against the Australian dollar, New Zealand dollar, British pound, euro. Long dollar today, for those of you that are wondering, when I look at Aussie US, I like the FXA. We have alerts that we wanted to build a put position. And so let me mention something here. We did this during the Covering Currencies session, and this is sort of the money ball or the market money math of trading, which is when we have a zone that starts at about 61, call it 61.70, and extends all the way to 63.10 in the Aussie US, where every pip is $10. So the fourth decimal place is $10. Every time we go from 61.67 to 61.68, that's $10. So imagine that $10 now going from 61.70 to 6,300, and you ask yourself, can I afford that? Can I afford that trade? Now, afford that trade could be initial margin. Afford that trade could be the cost of the option. Afford that trade could be, in terms of Forex size, do I need to go with a full lot, half a full lot, a mini, a micro, etc. So affording could be a number of things. But then specifically to risk, we ask ourselves, can I afford the trade from a current level? A lot of traders will say, Rag, I'm not comfortable with the risk from 61.70 to 6,300. I'm okay with, say, 62.30 to 6,300, 62.50 to 6,300, but not 61.70. So again, only you can answer this because, as I like to remind everybody, risk is not one size fits all. Right? Risk is absolutely not one size fits all. You know what you can risk, either emotionally or literally within your account. So the affording question is one that isn't asked enough. Can I afford it with a certain position size? Can I afford it with a different asset class? Maybe the Aussie US Forex or the Aussie futures or puts on the Aussie futures is not something you're comfortable with. So you might go with the FXA puts. Maybe the Aussie futures you're not comfortable with, so you'll go with the Aussie futures options, the puts. So position size and also asset class. Do I want to go, in this case, Forex, right? And go Forex versus futures versus options on the ETF or on the futures. So again, can I afford with a certain position size? Can I afford with a certain asset class? All right. And so at the end of the day, risk is your entry to your stop. And most traders, what they do is they start moving their stop around rather than moving to a closer entry to the stop. Most traders, to sort of skew affordability in their favor so they can get in now, will say, let's move our stop lower. That way I can justify the position, the more aggressive position. We do the opposite, right? We say, look, I can't afford from this entry. We'll call it aggro. There might be a moderate, there might be a conservative. Maybe one of those two works with smaller size or a different asset class. Maybe only at the conservative level can I actually trade the underlying asset with a certain amount of position size. That's affordability. So don't move the stop around. Think about smaller size, different asset class, or just foregoing that level altogether. Every trade is not going to be affordable for everybody. Now, as you trade more and more, your confidence increases, your skill increases, your account conceivably increases too. You're going to find what is affordable is going to become, you'll be able to cast a wider net into the market. All right. So what we want to do in the case of, say, the Australian dollar is, think about those FXA puts or those 6A puts. Think about different alternatives by way of position size, but nonetheless what we've done is we focused on the FXA June 19, and we're looking at that 150 limit. Now I will tell you guys what I'm bidding, and it's usually going to be buying close to or maybe just above. Maybe I'll become the inside bid for that option. Okay, all right, we put an order out there for HYG, making a bet on corporate bonds, high yield corporate bonds. VIX, I'm making a bet that lines up with my overall expectation that we're going to head back down lower pretty soon when this market's kind of going to get a good full dose of reality after a lot of the non-economic common sense reasons. And what do I mean by that? I've got to be careful of bias, right? I don't want to just sort of become an echo chamber of my own ideas, but the idea here is, do we really think that because we're getting a flattening curve that this is economically good news? It's humanitarily good news. It's great for humans. It's not necessarily great for the market quite yet. And the VIX has pulled back into a zone on the daily time frame that makes sense for us to think that if I'm making a bet on the market heading back down, there's a pretty good chance the VIX is going to head back up. And also that lines up with our bonds. If the market's going to head back down, really good chance that the bond market's going to head back up. So you see that we made bets on the VIX and the bond market, which is in harmony with the play of shorting or buying puts into the retracement of markets that are in downtrends. So, you think about the XLE, the XLK, the XLF, a lot of those alerts that I've sent out. All right. So you'll see how we're playing this with different instruments, but sort of playing a very similar psychology. And you'll notice something else. I don't hedge. I don't believe in it. I find most people actually lose more money in the hedge. Look, I'm not a hedge fund, right? If I have a hedge, it's called a stop loss. And if I move outside of that stop loss, I don't want to treat my trading book as my portfolio. There's a big difference. If you have a portfolio, longer term, 6 month, 1 year, 3 year, 5 year, 10-year time horizon, hedges are a different conversation. But for a trading book, for trades, I might be in for days, weeks. I don't want to hedge. That's what a stop loss is for. Okay. In fact, I think mathematically, even puts as stops are not going to work as well as the theory might sound. So if I've reached the threshold of either unaffordability, if I've reached the threshold of what I'm allowed to risk of my account, if I reach the threshold of what kept the trade valid, I'll just take my medicine, think about whether the overall trade idea is right, recalibrate, and maybe go at it again. But again, you'll notice that everything we do is in harmony. I'm not offsetting anything, right? I'm not offsetting anything at all. We're just looking at a larger theme and playing it in different ways. I call it going wide, not deep. I'm not diving into one narrative with a lot of size. I'm going into different narratives that have a similar theme. So if one narrative outperforms, another narrative underperforms, I've got a lot of different, as they say, hooks in the water, right? I'm actually, putting a lot of hooks in the water, and I'm assuming one of them's gonna get a bite, maybe lots of them, if I'm in good fertile water, which I think we are. Yes, I love to fish. All right, so back on over to our list, HYG, and then KRE. KRE is actually very much in line with this crude oil narrative that I'm watching, a lot of us are watching the narrative, the saga, the drama unfold in crude. Now I'm going to tell you, gang, so far, nothing I'm seeing is really wowing me in terms of what's happening in crude, because today we're starting to get that Russia is willing to cut production, and the number that was floated was 1.6 million barrels per day, 1.6 million barrels per day. Remember, the market has already been told, it already has discounted, it's aligned to, calibrated to a potential 10 to 15 million barrels, right? Algeria came out and said that. The president of the U.S. said that. Look, unless we get to 10 or 15 million barrels, there's a chance we buy the rumor, sell the news here, gang, because the market's already aligned with that. That's not a surprise. That's not better than expected. This is the market. It's a forward-looking discounting machine. All right, so getting what we expected is not all that interesting. If someone says, hey, I'm going to show up with a cake today, and at 5 p.m. they show up with a cake, you're like, wow, you're grateful and you're happy, but you're not excited because you already knew it was coming. In fact, if the cake is not what was promised, maybe it was only a cupcake, maybe they came with a cookie, and that's it. You go, wow, that was not what I was expecting. That is not what I had discounted was going to occur. You're actually let down. Right? So this market's expecting a pretty nice cake, and all they might get is a cookie. All they might get is a small cupcake. And if that's the case, buy the rumor, sell the news. And I'm thinking the more we've seen so much chatter around how big this number could be, the likelihood is that we're going to continue to be pretty disappointed with ultimately what that number is going to be. Then we have the compliance to that number. So what have we done? Well, the market that really rallied today was XLE. Is there a planet on which Chevron and Exxon do well if crude continues to move lower? Crude did not move higher, but XLE did. Another thing that I expect is going to be a lot of shale oil defaults, a lot of defaults in that area, in the Permian Basin. Because, why? Hey, at current prices, there's no way these, what have I done here? Oh, I put in, okay. At these prices, there's no way I'm going to have, and you know what we'll do here? Let me show you here. Let's do this. I wouldn't mind adding crude oil to the bottom here, but what I think is going to happen is the regional banks are going to have a lot of exposure to the default story, and KRE is rallying up into zones that I'm interested in. I've got two zones, 34.60. I price out the puts. And then also, and by the way, those puts were what? I'm pricing out the, you'll see it in the alert, the 35 puts for June. I'm giving myself time to be wrong for a little while as the market's in sort of a, it's celebratory mode, right? What's happening in mainstream media? Trillions of dollars, which apparently have gone straight into the stock market. Trillions of dollars, and the curve is flattening, and all this great news, which really at the end of the day is not going to amount to much if those small business loans don't hit really soon, if people don't get back to work pretty soon. I mean, there's a lot still hanging over this market. Historically, I've shared with you a lot of different looks about the reality of this market, meaning, take a look. This is the Dow Jones Industrial Average present. Here, let me make sure this fits here so you can see it. All right, present 1929. What happened? Lower lows, right? I'm a student of history, gang. I read a lot of market history books. What else can we look at? I have another image for you all that talks about 2008. That was 1929. What about 2008? What was the behavior back then? What kind of movement did we see? So I just showed you 29. Well, what about 08? Here's 08. And I don't know which one of these little rips higher we're in. I would say we're probably in either one or two, right? So are we going to head lower after a lot of gyrating? Yes, I do think history says this is not the bottom, gang. This is not a V bottom that Powell can come in and say, hey, I was cutting rates, but I'm not going to anymore. That was easy, right? This is not the same situation. V bottoms are very, very unrealistic in a situation like this. So that's why I'm building these continuation to the downside plays as we're rallying up. KRE is another one. It's a straight up trend following play on regional banks. I think regional banks are going to be particularly susceptible to shale oil defaults, okay? But we're going to have to probably, I'm very likely going to have to take a little bit of heat on some of these positions, because just like we can't pick the bottoms, we can't pick the tops. Just like we can't pick tops, we can't pick bottoms, right? So I scale into these positions little by little, knowing that, yeah, the market might move against me a little while, but this momentum is what I need to use, and nobody knows where the top of this retracement ultimately is, okay? So that's where we are right now. And yes, for those of you that are wondering, can we play Aussie US to the upside? Can we play US dollar, Canadian dollar on the Forex side? I should say Aussie US to the downside. Long dollar, short Australian dollar. Here we're long dollar, short Canadian dollar. This would be a buy. Aussie US would be a short. Can we play British pound US dollar? Absolutely. You'll see that I am not letting go the reins on those dollar buys, specifically against the Australian dollar, New Zealand dollar, Canadian dollar, British pound, and then also euro. Right? You won't hear me talk about the New Zealand dollar as much. One, there's not a currency share ETF. The futures are not super liquid. And quite frankly, to be in the Aussie is sort of a redundant thing to also play the New Zealand dollar. They're going to key off a lot of the same things. But in the meanwhile, we're also interested in shorting Australia, EWA. We'll be interested in the ETF of Canada, EWC. I've already sent out an alert for EWG, and we've talked about this too. Let's short Germany, because Germany's about 35% of their GDP goes to China. And so these downtrends are retracements, and this is where I think we have a good edge at the top of the range, at the 34 EMA wave, after all that bullishness, to buy those puts and take advantage of not necessarily lower lows, but just the market sinking back down in the direction that it has been going in. Okay? All right, so that's what we've got here today. I'll see you all in the next update.